As I continue to hunt for investing ideas to fill the part of my portfolio dedicated to an income investing approach, today I'm going to dip my toe into the pool of high yield credit. High yield, or junk as it's often referred to, manifests in various forms, which today I'll break down and figure out which ones will help my portfolio generate the income I need going forward. So hit that subscribe button and join me today, right here in the red zone. High yield is referred to as junk because it either has not been rated or has been rated below a triple B rating, which is considered investment grade. Some common types of high yield credit include corporate bonds, senior or first lien loans, which are loans that banks or private lenders have made to companies, collateralized loan obligations, which are loans that have been rated and packaged together and then resold in tranches or bundles. For example, AAA or triple B tranches. And finally, mortgage backed securities. Although some of these investments can rightly be characterized as risky, so is all of investing. You take risk for the potential to earn a reward, or you don't, and you can receive the risk free rate. If you're watching this video, my guess is that you're interested in more than just US Treasury bonds, but we're going to talk about risk up front so that we look at these investments with our eyes wide open. But before we get too sober, I'll just mention a few safety minded counterpoints here so that you can understand the other side of the risk paradigm. First is that in collateralized loan obligations, or CLOs, I can't find a single case where a triple A rated tranche of CLOs has ever experienced a default. It doesn't mean that they won't, or I didn't just happen to find the one or two cases where it has happened, but that's a pretty impressive feat. Second, a lot of the speculative or junk bonds and loans that fall into the high yield category are debt from some of the same companies that make up the Russell 2000, if that debt is public in nature. It doesn't make a lot of sense that we would be more willing to be equity holders of a Russell 2000 company or a small cap stock ETF where stock values can go to zero versus being a bond or loan holder against those same companies, as we would have a higher claim to any company assets as a debt holder. Although we would experience significant loss either way in a bankruptcy scenario, we would not likely have the entirety of our investment wiped out like that of a common equity holder. Taking a deeper look at the primary risk of default, as of October 2025, the default rate seems about average and is generally held at the same overall level for about the last 2 years. COVID caused that rate to temporarily go to 6%, and we see that back in the great financial crisis, the default rate peaked at around 12%. I covered private credit and its historical default risk in this episode, where I discussed business development companies, or BDCs, as they are some of the primary lenders in the private credit space. To understand the next chart, I just want to make sure you're familiar with the concept of credit spread. It's basically the difference between the yield of a US Treasury and, for example, the corporate bond you are investing in of the same duration. It's really a measure of how much you're being compensated or how much higher your rate is for taking on the greater risk of default that comes with corporate credit. As we can see from the chart, the credit spread currently is fairly low historically. This should be telling us that the market as a whole doesn't see any systemic default risk, because if it did, we would see COVID or even GFC type of levels. Notice, however, before the GFC, the credit spread did start to widen, as it was an indicator that the so called financial plumbing had some problems. The last chart from this Schwab study that I found interesting shows that high yield bonds have been more likely to be downgraded in the last few years than upgraded, unlike their investment grade counterparts. So, just because credit spreads are very low historically doesn't mean that there's still not a wall of worry. Now, despite the risks, investors have consistently looked to high yield bonds as a way to generate a higher level of income. In my own portfolio, I'm looking for the right high yield credit investments to fill about a 6% allocation. So, how will I find the right ones? Here are some first level general screens that I'll look for. First, no individual holdings for me. I'll use funds only to diversify the risk. The same concept, really, as staying away from individual stocks and instead investing in a fund. Second, I probably won't consider any fund that wasn't established prior to the great financial crisis, as that was the last real stock market shock and real bear market that we've had. And I want to understand how the fund performed during that time period. If you remember from the default chart I showed earlier, that was the only time that we've had that 12% default rate, which is double the shock experienced during the Cerveza virus related decline. Third, I don't really like mortgage backed securities due to the role that collateralized debt obligations played in the GFC days, and therefore the lower is better in terms of the percentage of these that are in a fund's portfolio. Next, the higher the senior or first lien loan percentage, the better, as opposed to second liens. And finally, the higher rated the portfolio, the better. So double B is better than triple C. As a lot of these funds I'll be interested in will be closed end in nature, most of them will use leverage. If you're unfamiliar with closed end funds or want to get a more comprehensive list of screens, you can check out this video. The maximum leverage I'm comfortable with is about 30% as my own personal general rule of thumb. Finally, when I do start to scale down my list of funds, I'm looking for an earnings coverage to be consistently close to 100%. Earn coverage is how much of the distribution the portfolio is actually earning through income produced by its underlying holdings. Now, just looking at a screen of closed end funds starting before the GFC and currently using less than 30% leverage, I get this list. Quite extensive. If looking at it makes you tired, don't worry, I won't go through all of them on this episode or any other episode. I will, however, sort through these and take a look at about six of them for a comparison in a later episode where I actually pick the one or more that I'm actually going to invest in. Having done some preliminary groundwork, here's a list of funds that I'm currently watching. First up is from PIMCO, which is no surprise as they have a reputation for being cash printers. The one from PIMCO I'm most interested in is the Corporate and Income Strategy Fund, ticker symbol PCN. What I like most about PCN is that it's never cut its dividends since inception in 2001. Next up from Guggenheim is its Strategic Opportunity Fund, ticker symbol GOF. What I like most about this fund is it has also never cut its dividends since its inception in 2007, and it's even raised it a few times. Next up from BlackRock is its Corporate High Yield Fund, ticker symbol HYT. What I like most about this fund is currently trading at a good discount. Next up are TEI from Templeton and EMD from Western Asset, which are emerging market debt funds that I'm interested in for international diversification purposes. Finally, I have MCI on the list from Barings to look further into only because it's still going strong from 1971 to today. In a future episode, I'll dive deeper into EMD, HYT, GOF, PCN, TEI, and MCI to pick one or more for my own portfolio. So, which high yield investments do you hold? Feel free to let the community know why you chose that fund or funds and continue to hold or drip back into that fund. If you're interested in other high yield investing opportunities, check out this video on master limited partnerships. Until then, I'll see you next time right here in the red zone.